Welcome to the deep dive. Today, we're digging into the Q3 2025 earnings for a major global travel platform. Lots to unpack.
Absolutely. Our job today, cut through the financial jargon, really pinpoint what drove this big outperformance, and sketch out what they're seeing for the rest of 25.
Okay, let's get right into it. Q3. Wow. I mean, the headline seems to be that demand is just incredibly strong globally, and these guys executed really well.
That's exactly it. They didn't just meet guidance, they smashed the high end of it, pretty much across the board.
Right.
And when you see that kind of beat everywhere, it suggests something more than just, a good summer season. It points to real structural health.
So let's start with volume. That's kind of the base layer, right? Room nights hit 323 million. That's 8% growth year over year.
Yeah, 323 million.
Now, 8% sounds healthy, but you mentioned the beat. What's the story there?
Well, the context is expectations. That 8% growth, it actually came in almost 3 full percentage points above the top end of what they themselves were predicting.
Ah, okay. So a significant volume surprise.
Exactly. More rooms booked than even their optimistic forecast. That's where it all starts.
And naturally, that volume bumps up the total value booked. Gross bookings, or GB, hit nearly $49.7 billion. That's up 14% year over year.
Now, hold on a sec. With that 14%, it's a great number, but we need to mention the currency effect, the FX.
Right, the exchange rates.
Yeah. If you strip out the tailwind from the dollar being weaker against other currencies of what they call constant currency, or CC, the growth is closer to 10%.
Okay, 10% CC growth, still strong.
Very strong. And that FX lift gave them about, call it 4 percentage points on the reported number. Right. But even at 10%, they beat their own guidance for gross bookings.
Also by about 4 points. Right?
Yeah, roughly 4 points. So what drove that, it was kind of the perfect combo. You had that strong room night volume we just talked about. Plus, the average prices people paid per night, the ADRs, were about 2% higher than they expected. So more bookings and slightly higher prices than forecast.
Which tells you something about the consumer maybe feeling a bit more confident.
Could be. And it all flows down to the bottom line. Revenue hit $9 billion, up 13% reported.
And profitability. Adjusted EBITDA looked really strong.
Yeah, by $4.2 billion. That's up 15% year over year. Shows good operating leverage.
And the earnings per share, adjusted EPS, that number jumped out at me.
Oh, absolutely. A massive $99.50 per share, up 19% year over year. You just don't see numbers like that every day. It's clear evidence of a really exceptional quarter.
Okay, so huge numbers. But let's peel back the onion a bit. Where did this growth actually come from? It wasn't just luck, right? There must have been specific things working well.
Right, which takes us to the operational drivers. If you look at that 8% room night growth, geographically, it was pretty balanced. That's always good to see. Kind of de-risks things.
So Europe and the U.S.
Both solid.
Yeah.
High single-digit growth in both regions. But the faster growth, the real acceleration, was elsewhere.
Asia and rest of the world.
Exactly. Both delivered low double-digit growth. And that's where they've been putting a lot of investment, those high-growth areas.
Interesting. And you mentioned the U.S. There was something specific going on there.
Yeah, little nuance. U.S. growth actually picked up speed compared to Q2. And it seems like that was mainly driven by two things. First, more Americans traveling outbound internationally.
Okay.
And second, some real momentum in their B2B segment.
B2B. Remind us what that is again, business to business.
Yep. Essentially, other travel companies or partners using this platform's tech and inventory to power their own travel sites or offerings.
And that's becoming more significant.
Apparently so. They specifically called out that their U.S. accommodation growth was meaningfully outpacing the wider industry. That suggests this B2B engine is giving them a market share boost maybe competitors don't have.
Got it. Okay, let's switch gears to their big strategic bets. First one, alternative accommodations, AA homes, apartments, that kind of thing. How's that doing?
This is a huge win for them strategically. AA room nights grew around 10% year over year.
Which is faster than the overall 8% growth.
Exactly. So it's actually pulling the average up. It's a growth engine within the growth engine.
And you see that in the mix too. Their AA listings are up 10%, over 8.6 million now. And it represents, what, 36.1% of Booking.com's room nights?
36.1%. Yeah. That's a really strong sign they're competing head on and effectively with the pure play vacation rental sites.
Okay, bet number 2, the connected trip. Moving beyond just rooms, right? Selling the whole package.
Precisely. Flights, cars, attractions. The idea is to own the whole journey, build loyalty, get more share of the wallet.
And how's that progressing? Is it still early days?
It's definitely progressing. Those connected transactions trips where someone books more than just a room grew in the mid 20% range year over year.
Mid-20s. That's pretty fast.
It is. And maybe more importantly, that's the theory. And you see some evidence in the individual component growth. Flight tickets booked were up a huge 32% year over year.
Oh, yeah.
And attractions, things like tours and activities, up nearly 90%. Okay, admittedly off a smaller base, but still, very rapid growth.
And all this ties back to getting customers to book directly with them, cutting out middlemen.
Absolutely. It's about shifting volume to their most profitable channels, like the app and their own website. We look at a couple of metrics here, tracked over the last year, TTM.
Okay, first, the mobile app. How much business comes through the app now?
It's now in the mid 50% range.
Yeah.
That's up from the low 50s just a year ago. So significant shift.
And the direct mix. People booking straight on their site, not coming through, say, search engines.
That's the B2C direct mix, business to consumer. That's now hitting the mid 60% range, also up quite a bit from the low 60s last year.
And they connect this directly to their loyalty program, Genius.
They do. They argue that Genius is key to driving this direct behavior.
So how well is Genius actually working? Are people engaging with it?
Seems like it. Customers in the higher tiers, Genius levels 2 and 3, these are the more engaged members, right? They accounted for somewhere in the mid 50% range of all Booking.com room nights over the last year.
Mid 50% from just level 2 and 3 members?
Yeah. So it suggests the program isn't just, giving perks. It's actually concentrating their best customers' spending onto their platform and, crucially, into those lower-cost direct channels.
That really sets up the next piece nicely. The outlook, Q3 was great, it's in the bag. But what about looking forward? Guidance and this efficiency stuff they talked about.
Right. So while they still see travel demand as pretty solid overall, they are guiding for things to moderate a bit, in Q4 specifically.
Moderate how?
Well, they think the booking window, how far in advance people book, won't be quite as stretched out as it was in Q3. So for Q4, they're expecting room night growth to slow down a bit to between 4% and 6%.
Okay, 4 to 6%. And gross bookings.
Expected to grow 11% to 13%, and revenue 10 to 12%. Still solid growth, just not the explosive numbers we saw in Q3.
Right, makes sense. And adjusted EBITDA for Q4.
They're forecasting between $2.0 and $2.1 billion. But honestly, the bigger story here isn't just Q4 moderation. It's the full-year picture and the efficiency gains.
So they raised their targets for the whole year?
They did, across the board. Full-year room nights now expected up about 7%. Gross bookings up maybe 11% to 12%. And adjusted EBITDA, this is the big one, up about 17% to 18% for the full year.
Wow. Okay, so even with a slightly slower Q4, they're confident enough to lift the full-year profit forecast significantly. Where's that confidence coming from?
It seems to be coming from internal execution, cost control, efficiency. This, I think, is maybe the most important takeaway from the whole report. Their adjusted EBITDA margins are now expected to expand year over year by about 180 basis points.
180 basis points? That's a lot more than they thought before, isn't it?
It is. They were previously guiding for about 125 basis points of margin expansion, so this is a substantial upward revision.
And 180 basis points basically means they're getting way more profitable on each dollar of revenue, right? Getting more bang for their buck.
That's exactly it. It's financial leverage in action. Their revenue is growing faster than their costs, both their marketing spend and their sort of fixed overhead costs.
Okay.
They're managing to grow the top line and expand the product without costs running away from them. And a lot of that is down to this thing they call the transformation program.
Right, the transformation program. Sounds like corporate speak for cutting costs. Is there a risk they cut too deep?
That's always the risk, isn't it? Degrade the experience for users or partners. But they seem confident these are, smart cuts.
Yeah.
Targeting real waste and overlap, not core functions.
And they must be confident because they actually raised the savings target for that program.
They did. They now expect total annual run rate savings from this to be between $500 and $550 million, up from prior expectations. That's $500 million in efficiency they're aiming to pull out.
Even though it cost them money in Q3 to do the transformation, what was it, $105 million in costs?
Yeah, about $105 million in Q3 transformation costs, which, importantly, they exclude from that adjusted EBITDA number. But yes, they're spending cash now to get those bigger savings later.
And looking even further out, they talked about generative AI, not just as hype, but as part of the strategy.
Explicitly. They see it as a pretty major opportunity, both for improving the traveler experience and for helping out their partners, hotels, and hosts.
Did they give any, concrete examples?
They did. They mentioned Agoda, one of their brands, using an AI chatbot for complex customer questions. And Booking.com has a smart messenger tool for partners that uses AI to help with responses.
Interesting.
Their angle seems to be combining AI smarts with their own massive amount of travel data, and they highlighted they're working closely with AI leaders, mentioning OpenAI specifically.
Okay, before we wrap up, we absolutely have to touch on the fine print, the nuances, the risks. Sometimes the most important stuff is buried there.
Couldn't agree more. First, just a quick reminder, we've been throwing around adjusted EBITDA and adjusted EPS. Great numbers, but they are non-GAAP. The company always points out you shouldn't substitute these for the official GAAP figures like net income.
Standard disclaimer. But there was something else in the disclosures this quarter. Something pretty big. An impairment.
Yes, that's the elephant in the room, really. A huge write-down related to Kayak, almost $500 million.
Wow. Can you break that down?
Sure. They took a $180 million impairment charge on Kayak's goodwill and another $277 million impairment on Kayak's intangible assets. Added up, that's $457 million, basically wiped off the value.
Why? Kayak is a well-known brand. What happened?
The trigger was a reduction in the forecasted cash flows for the metasearch part of the business.
Metasearch, like comparing prices across different booking sites.
Exactly. And the reason for the lower forecast, they expect higher customer acquisition costs, CAC. Basically, it's getting more expensive to attract customers to those metasearch sites.
Ah. So even while this company is getting more efficient with its own direct marketing through Genius, they're admitting that the underlying business model of metasearch, which Kayak relies on, is getting tougher because it costs more to get eyeballs.
That seems to be the signal. It's a potential structural headwind for that whole industry segment. The cost of routing customers is going up.
Which ties neatly into the forward-looking risks they list, I suppose.
It does. I mean, they list the usual suspects, bad market changes, geopolitics, macro uncertainty, but they also specifically call out competition, marketing efficiency. There's that CAC issue again, and operational risks like data privacy, cyber attacks.
And they even mentioned AI as a potential risk, didn't they? Despite being optimistic about it.
Yep, risks related to the development and use of GenAI. So it's both an opportunity and a new kind of operational risk factor they have to manage.
So it's a bit of a mixed picture under the surface then. Great execution on their core platform, driving efficiency, but pressure on the older metasearch model.
That sums it up well. Massive success driven by loyalty, the connected trip, and cost discipline. But running alongside these structural pressures, particularly rising acquisition cost, hitting some legacy assets.
So the key takeaway for you, the listener, it seems like despite all the global uncertainty out there, this company's internal engine loyalty, that connected trip vision, serious cost savings is really firing. It's giving them the confidence to raise profit expectations significantly. They're finding growth and margin from within.
Exactly right. That internal momentum is key. And it leaves us with a final thought for you to chew on. We saw alternative accommodations hit 36% of room nights, a huge success. And the connected trip, adding flights and attractions, is growing fast. But those non-accommodation parts often have lower margins than selling a hotel room. So the question is, how much bigger can flights, attractions, and maybe even AWA get as a percentage of the total business before that changing mix starts to put downward pressure on the overall company profit margin, potentially eating into some of those hard-won efficiency gains? That's the structural balancing act to watch heading into 2026.